This week we will learn how to calculate financial cash flows. Before doing that, we will see briefly what types of decisions you will make as a manager. Corporate finance decisions. There are 3 decisions almost every manager will make within their organization. Typically, the low-level manager starts from working capital management decisions. This is one about short-term decisions, and it touches the company's short-term assets and liabilities. It is also known as daily operating decisions. After you become an upper-level manager or key manager in your company, you will begin to make capital budgeting and capital structure decisions. These long-term investment decisions typically involve millions or hundreds of millions of dollars. Some examples of capital budgeting are new product launches or a second offering in another country. These projects have a high cost and generally involve a long period in the budgeting process. Suppose you have one project, maybe opening another market in another country, and the cost is under $200 million. If your company decides to do it then, the next set of decisions are capital structure decisions. Another name for this is how to raise money. Capital raising is typically done by the company selling equities or company stocks and/or raising debt. On the previous slide, we briefly discussed 3 decisions a manager may have to make. We see the 3 decisions here as well. The 3 decisions are capital budgeting decisions, capital structure decisions, and working capital management decisions. Lower-level managers or entry-level managers typically make working capital management decisions. Let's say you manage inventory and you order an item. This makes the company's inventory and asset value go up. Typically, the company does what we call credit purchase or credit buy. This means the company does not pay for the whole amount of the inventory order, they only pay partially. The company then returns to the supplier and pays them a little later, in say 3 to 6 months. Whenever you have a credit purchase, your current debt will go up. Entry-level manager decisions will touch the company's current assets and liabilities. When you move into a higher level management position, you will discuss and decide upon the company's long-term investment decisions. These are capital budgeting decisions. That is something about the fixed asset area, such as purchasing another factory or maybe another product line build-up. This is typically a long process and you need capital budgeting for this. These types of decisions can involve hundreds of millions of dollars or even billions of dollars. Once the long-term investment and budget decisions are made, you then have to decide how to raise the money. Suppose it requires $200 million. The next decision is a capital structure decision. This is also called how to raise debt $200 million. A company typically sells equity or stocks, or they may sell company bonds. Bonds are a way a company borrows money. Quite often, a company will structure the decision by utilizing more than one of the options. They can sell company stock and company bonds to come up with the required financing. The goal of financial management are managers. Managers are agents hired by owners. A manager's job should be to increase the company's owner's wealth. The company owners are the shareholders. This means your primary job should be to raise the stock price through your wise decisions. If you make good decisions in the 3 areas we discussed, the stock price will go up. This is another way to show how well you do your job.